Hi, I'm James, and in this episode of Making Sense of the Numbers, we're going to talk about the debt to equity ratio. And I'm going to use two examples of companies that have been very popular in the media over the past few months. So to start off, the debt to equity ratio is one of those ratios that value investors should have in their toolkit. Now, much like the other ratios, it's not a be all and end all, but it is a great tool that we can use to get an idea of how risky our investment is based on how much debt the company actually uses to fund its operations. Okay, so what is the debt to equity ratio? So the debt to equity ratio is a ratio between the total liabilities of the company divided by the owner's equity, or the total equity of the business. Now, if we remember back to one of my other videos where I talked about the balance sheet, the total owner's equity is equivalent to taking all of the assets of a company, selling them, so turning them into cash, paying back those liabilities, so the total asset value minus the liability value is equal to the total owner's equity value. And if you want to watch the video on that, I'll leave a link up here somewhere and you should be able to skip through. I've got timestamps on the videos now, so you'll be able to skip to the balance sheet section and have a look if you'd like a refresher. So what is the debt to equity ratio actually telling us? Now, this is a ratio that you'll be able to see if you look up a stock on any number of websites. Like I use auinvesting.com, and it's one of the ratios that pop up quite frequently when you're searching stocks there. Now, what it's telling us is it's giving us an idea of what is called the gearing of a company, which basically means how much debt the company uses to fund its operations, versus the amount of money that it uses to fund its operations from either selling new stocks or shares to the market to shareholders by capital raising, or by just funding its operations with the money that it keeps from its operations. So if it's a profitable business, well, it keeps some cash in the bank after it makes a profit, and then it uses that cash to fund some of its operations. Now, this is a particularly important ratio to look at in the current environment of, economic crisis, because it can tell us, with respect to the equity, how much debt it's actually holding and how much the company's obligations are. Now, the only way a company can go bankrupt is if it has debt, because in order for a company to go bankrupt, it has to owe money to someone else that it can't actually pay. So the lower the debt to equity ratio in a time like this current environment can actually be a really good thing for us as investors in terms of like a bit of a safety barrier to sort of ensure that we don't lose all of our investment. Now, I made another video called the bankruptcy test, which talks about a similar ratio that works really well with this debt to equity ratio. And I'll leave a link to that here. But these two indicators, that one is the current ratio, this one is debt to equity, can give us an idea if, in the current environment of an economic downturn or a, economic crisis, then if that company stops, getting so much money coming in the door, is it likely to go bust soon? And so let's go through a couple of examples now to sort of illustrate the point. Okay, so for example number one, I'm not going to tell you the company name straight away, but we'll first plug in the numbers. So this particular company has $17.6 billion worth of liabilities. So we'll plug that in. This company also has $2.7 billion worth of owner's equity, which gives us a debt to equity ratio of about 6.5. Now, this number is often expressed on websites as a percentage, so a debt to equity ratio of 650% debt to equity. Now, that's an example of a high debt to equity, and the company that I'm talking about here is Qantas. Now, company number two has around $530 million of total liabilities and $840 million of owner's equity, giving it a debt to equity ratio of around 0.6 or 0.62 from memory. Now this company is, I've said it a lot on this channel, Afterpay. So these are both companies that I have held and sold. So I sold off my Qantas position a couple of months ago that I bought in March. And these two companies kind of demonstrate the difference between, a high debt to equity ratio in the case of Qantas and a low debt to equity ratio in the case of Afterpay. So now I'm going to pose a question to you. If you were a bank and you knew both of the CEOs of these companies, and both of them came to you and said, hey, I want to borrow some money. We just want to protect our balance sheet. We want to get a bit more cash in the bank. Will you give me a loan? Now, if you just looked at the debt to equity ratio of both of these companies, which one would you be more likely to lend to? Purely based on the debt to equity ratio here. Now, if we have a look, in the case of Qantas, it already has $17 billion worth of debt approximately, and only around $2.7 billion worth of owner's equity. Meaning, if push came to shove, how likely are you to actually get the money back that you lent them? On the other hand, if we look at Afterpay, they've got around $530 million worth of debt that they owe, but they've got around $840 million worth of owner's equity. So in that case, if you were to lend money to them, how likely do you think you would be that you would be able to recover all of the money that you lent to Afterpay? And Sean, if you're watching, I know you're going to be hating me for using another Afterpay example, so I'm sorry. Now, it's important not to just look at the debt to equity ratio in isolation. So it's kind of unfair for me to compare Qantas to Afterpay as I have, because they're two very different companies. So what we would like to do is, when we're looking at stocks that we might like to buy, and we're looking at the debt to equity ratio, we should compare apples to apples. In this case, I've compared apples with oranges. The apple being Qantas in this case, which is a type of business that has to buy very expensive planes in order to operate. Well, it's quite unlikely that a company like that would be able to buy aeroplanes to continue to operate with just cash that it has in the bank. It's actually much more likely that airlines have to go out and borrow large amounts of money in order to purchase the airplanes in order to run their business. Whereas on the other hand, a company like Afterpay, the oranges in this example, that is like a software fintech company. They don't have to go out and buy airplanes. They don't have to get a lot of debt in order to, buy buildings or, machinery or whatnot in order to operate their business. Instead, they can, raise a small amount of money, a large amount of money through capital raisings by issuing shares, and then only take on small amounts of debt where they need to in order to fund their operations, which means their debt to equity ratio is much lower. So we can expect that companies like in the energy sector, maybe even the mining sector, those kinds of companies would have very high debt to equity ratios. Companies that have to buy real estate or very expensive machinery and equipment to operate, we could expect them to have quite high debt to equities. Whereas software companies, on the other hand, which can basically build a software, with a team of 10 people and then scale it up to $1 billion company, well, we could expect their debt to equity ratio to be much lower because they don't have those huge capital outlays in order to, operate their business. So to wrap it all up, the debt to equity ratio gives us a great tool to identify for our investment options which are more safe in the current uncertain economic conditions. Now, it's not an absolute, and it's important that we compare apples with apples, software companies with software companies, oranges with oranges, airlines with other airlines, to make sure that we can see, well, based on the kind of sector that we're looking to invest in, how competitive is this company's gearing ratio? How safe are they based on how much debt they actually have in the current environment? All right, so that's it from me today. Thanks for watching all the way to the end. If you found this useful, please give it a like and let me know what kind of content you'd like to see next. I'll speak to you soon. Cheers.